All right, we're live on YouTube. Welcome, everybody, to the Alternative Investing Club. Today is November 8th, 2024, and we're going to get started in just one moment.
While we're waiting, Daniel, do you make Chris or I presenter or host so that we can share the deck?
I think you can share it right now.
Yeah.
I
Okay.
think I actually have it set so that anybody can share. And I've had the amazing luck that in 5 years of doing this, nobody's tried to take over the
I was gonna
sharing.
say, okay.
Nobody has tried. I've never had to boot a person either, which I'm kind of dreading the day that that happens because I honestly I don't know how to keep someone out once they're booted. They'll just sign up with a different email address.
Oh my gosh.
All
Can everyone
right.
can everyone see my screen? See the screen?
Yep.
Yes. Let's kick it off here with letting our speakers know where you're coming from. So if you could type in your city and state into the chat, I would love to see where we're coming from here at Dallas, Arizona, Oregon, Folsom. I wonder if Folsom is still the location where we get the most people from. Back when all my metrics were being measured through meetup.intel.com, there were some good metrics just on where people were coming from and even what Intel campuses they were coming from, which was really fascinating. And Folsom was our number one location for people to be coming in from, followed by Portland, then Chandler, then San Jose. But it looks like since the pandemic, hello, Cheyenne. Oh, that's Jeff. You're a newbie. You don't count yet. Alexandria, Virginia. All right. We will kick it off here. First of all, the announcements. I want to say thank you very, very much for being here. This is the Alternative Investing Club where we bring in great speakers every week. This week we have a pitch or a deal. So we have a speaker that's coming in that is going to present their opportunity to the club. Feel free to reach out to them. I am not going to be involved in that reaching out at all. It's just you directly reaching out to them through the contact information that they share. And we're trying to fulfill that goal of not only being educational, but providing paths to opportunity for investors that are in this group. So that's what we are doing today. We also have two deals that are available through the club. And the first one is the Colorado 3 oil and gas deal. And in terms of people that have their legal papers and wires in, we are at about the 3/4, 5/7 actually closer to. We're almost there, but it's always that last little bit that's hard to bring in. So it's a great opportunity because the tax benefits that accrue to you through this deal are actually able to offset your earned income and your capital gains. And so if you have an Intel check and you look at how much they take out each 2 weeks, you can get some of that back by putting in a investment that'll give you a tax deduction. Or if you have a lot of appreciation, not from Intel stock, from other stocks that you want to offset, it's a good way of doing that too.
And
of course,
are we still on track to get that deduction this year, 2024?
Yeah,
tax?
actually, the way it works, and I meant to follow up with you on an email with that. The deduction's already locked in for this year because the ownership is already established. The investors, the way the oil deal works, goes to pay the expenses, and so it's already locked in for this year.
Excellent.
All right, and the second thing is, of course, the Alternative Investing Club Fund. We have a fund that puts together 7 to 10 passive strategies. And we are actually evaluating Jeff's indie fund, indie film fund for that fund. So he'll come to present on that soon. But we have a variety of other things. If you're interested in seeing all the details, you can go to alternativeinvestingclub.com/fund. And with that, I am going to turn it over to Lauren and Chris. Lauren and Chris, welcome to the Alternative Investing Club.
Thanks, Daniel. Thanks so much for having us here today. Happy to be here speaking to everyone on a Friday. I actually love doing these things on Fridays. I feel like it's a good energy kick as well. So I'm Lauren, joined here today by Chris. I'll let him introduce himself so I don't do all the talking. But, Daniel and I had met, just to give you guys a little bit of context, about a month ago. And something that really inspired me was how a lot of people were coming from Intel or tech or software, bigger companies. That's my background. So very familiar with kind of navigating the alternative space. And now that I'm in it, love to share that and the opportunities and different ways to get invested with former colleagues of mine. So Daniel, I've actually mentioned your group to a lot of people that I used to work with at tech companies. So hopefully you'll be getting some leads there. But today, Chris, you want to introduce yourself a little bit since I've been talking this whole time?
No problem. Thank you. I'm Chris 70, and we'll talk more about our story and stuff. But as the founder of 70, I'm just, again, same thing, Friday afternoon. Love telling people our story and what we do and sharing the insights and giving people other options within the alternative investment space.
And just to let you guys know, the way that we usually do comments is to have everybody put their comments into the chat. And I, as the moderator, am happy to follow that for you so that you can concentrate on your speech and you don't have to follow it. And I'll just judiciously interrupt you at, transition times or at times where it's relevant to ask the questions, unless you want to hold them all to the end. What would you prefer?
Yeah, I'll keep the chat open. I was just going to say, if anyone has questions, put them in the chat and I'll either answer them right there, or if we're in like the appropriate area, or we'll hold them till the end. So either way, we'll answer the question. So just keep them coming as they come up. Like Chris said, we're the founders of 70 Investments. And today we're going to talk to you about mortgage note investing, a little bit about how we do what we, who we are, how we got here, what mortgage note investing is. Some of you might be familiar with it. Most people probably aren't. It's pretty niche of an asset class. We're going to talk about something that's relevant to everyone's mind, this specific asset class, mortgage notes, in the current economic climate, 70's offerings, what we do, and some case studies and Q&A. So buckle up. We'll keep it quick, but we'll give you a lot of information. If hopefully this is, like you said, it's available on YouTube, so you can go and rewatch the replay if you have any other questions and reach out. So we are 70 Investments. We are a real estate investment firm that specifically focuses on buying mortgage notes that are secured by single-family homes throughout the US. So we're essentially assuming the position of the bank. We're buying these at a discount, typically anywhere from 30 to 60%, and we are flipping them. We like to say we fix and flip mortgage notes, and we'll talk a little bit more about what exactly that looks like and how that plays out in a second. But we're buying them at a discount, increasing the value, and selling them back to the secondary market for a profit.
Here we just put up our disclaimer regarding our different offerings. We're not going to read this entire disclaimer for everybody. We will leave it up here for a second. People who are watching this can go back, pause the screen. As I like to say, this is the Apple terms of service thing to scroll through for people just to familiarize. One thing I'll mention here is all of our information is on the SEC website through our offering circular, because this is a Regulation A+ offering.
So a little bit about our backstory. Chris, you go first.
Okay.
I do a lot of talking in the beginning slides.
Yeah. Oh, thank you, Lauren. As Lauren mentioned, she came from a tech background. My background is very different. I have always been in real estate. I went to school for civil engineering, and pretty much as I got towards the end of my degree, realized, okay, I don't want to sit here and design bridges my entire life. I want to do something that's a little different, and got involved in real estate. And after 20 plus years of being in real estate, one of the things that I failed to do as I got older and started a family was investing outside of my 401k. And I started buying rentals, and then realized that was too much work, and found mortgage notes. And we'll talk more about mortgage notes, it is very different than other debt funds, because most people are familiar with private lending, but we'll talk more about notes. But ever since I got in mortgage notes 8 years ago, it's something that I've been very passionate about. And realized that it's something I needed to do to continue to grow my personal portfolio, as well as now start these funds to assist others in growing passive income.
So same, but very different. I graduated university, played collegiate sports there, went on to get a software sales job at 2 tech companies, went public I went through IPO with them. And at the same time was also volunteering locally at a high school water polo club, because that's what I played. Wanted to give back and be involved in the community, and realized that a lot of the parents there they were always there. They were at practices, they were at games, they were at everything. Typically own their own business or invested in real estate. And so at that point, I started using my sales commission to diversify, look into other things, join clubs like this, attend self-directed IRA meetings, stumbled across mortgage notes, started to build my own portfolio of notes, met Chris, and then we started working together to run some of our past funds. So this isn't our first rodeo, but launched this specific offering based on our kind of mission when Chris and I were starting, realizing that when we were starting, you either had to be accredited, or even if you were accredited, you had to put in 50, 100, 250K. There wasn't really an easy way to kind of dip your toe into alts. You were either going for it and you couldn't really diversify outside of, again, one offering if the minimum was 50 or 250 or whatever it was. So that leads us to our mission, which is the next slide, which was really to democratize investment opportunities, making something accessible to investors from both an accreditation standpoint and a minimum investment standpoint, and meeting our returns to our investors, while also providing a win-win solution to borrowers. Now, here we're going to talk a little bit about the mortgage note industry and an overview. So, I don't know if that's the next slide, but essentially this is a massive industry. There's about 14 trillion in single family residential debt floating around, and anywhere from 250 to 500 billion in single family non-performing debt. So in terms of how big this industry is, it's massive. What we do at 7E is really just scratching the surface. So in terms of inventory and being able to get assets, you can see it's a massive industry. We're not looking at something that's super competitive. And since COVID, it's been a lot harder for individuals to get into because of the requirements by the Consumer Financial Protection Bureau when it comes to lending and practices around lending. So a little bit about the industry and kind of its size.
One thing I'll add, Lauren, to this is people will say, okay, it's great, there's all this mortgage debt, but how often is it sold? And for people who own a house, after you've bought it like 60, 90, 120 days later, did you ever get that letter in the mail that says, now please send your payments to XYZ, or any point in time when you own your loan? That's because your loan was sold. So more than half the mortgages in this country get sold, securitized. So it's not only the size of the industry, but the amount of trading that goes on is significant as well. And when I bought my first house, I actually didn't realize there was a difference between a mortgage and a note. And we just want to give people a brief explanation on the difference between the note and the mortgage. A note is just a promise to pay. It's an IOU. It's a 3-page document that says, I'm going to pay you back $500,000 at 6% interest over 30 years. Just kind of a small contract. The mortgage is really the teeth behind the deal. I'm assuming nobody's going to give you $500,000 just to go do what you want with it. The money that you get on the note is, the mortgage says it's for this specific property or this specific parcel of land. And it also defines all the terms that you have to take care of it. What happens if it's in a default? That's the instrument that gets recorded at the county. So everyone is on record to know that money is owed to that lender.
So now you know what a mortgage and a note is. What is mortgage note investing? Essentially, it's an alternative investment strategy secured by physical real estate. In our case, single family homes with significant equity coverage. Essentially, you're assuming the position of the bank. When you buy a note, you become the lender of record. You're buying the rights to the borrower's future mortgage payments and the right to repayment according to the terms of the note and the property should they decide they are not going to pay and it goes into default. So you're typically buying these at a discount, and kind of we talk about that here on the next slide because there's two different types of mortgage kind of, I guess you could say, classes. There's performing and non-performing. Our portfolio is a blend of the two. So performing is when a borrower is, paying their mortgage as expected per the terms of their agreement. Typically, you're getting those for anywhere from 60 to 90% of the outstanding balance. Again, these are all purchased at a discount, which makes part of our process, that fix and flip. And then you have your non-performing when the borrower has failed to make payments for at least 90 days or more. And typically those are anywhere from 40 to 60% of the loan's outstanding balance. So again, purchased at a discount just depends on if they're performing and non-performing.
And I've seen some questions like, why do people sell at a discount or how we make money on notes? And this is the area where Laren can talk about how we generate revenue on.
Yeah, and we will talk
loans.
about what motivates sellers. I just had to make sure that slide was in here, but it is. So we'll talk about that in a second because it is a common question. But this is really kind of the outline of our, I guess you could say, investment process, or how we make money, how we fix and flip notes. So we like the analogy of fix and flip because most people are familiar with fixing and flipping a home. You may have seen 1 or 50 HGTV shows on it. Buying loans on single family homes at a discount. So we talked about we're buying some performing and non-performing loans. The performing obviously provide us with that instant income because they're performing, they're paying on time. And then with the non-performing, there's really two kind of main exit strategies and multiple within those, but two routes that it can go from there. So if a loan is non-performing, we immediately are sending that letter some of you might have received saying, your loan was sold, we are now your lender of record, payments come here. And really, you can negotiate. What we do is we send that letter, and borrowers have two options. And the top option in blue that you'll see there, I always point to it, realizing that I'm pointing backwards and I don't have an arrow on the screen. But the top arrow, thank you, Chris, that's about 90% of our portfolio. So really negotiating a payment schedule with the borrower where we're saying, okay, and we'll talk about why someone would not be paying and what brings them to the table a little bit later. But essentially, we work with that borrower. We get them on a 6-month, what's called trial payment plan, where they're making their monthly payment. And then at the end of that, we are modifying the loan. So we're generating revenue from their monthly payments. We're modifying the loan, extending, adding their arrears or past due, maybe extending the term. And then we're seasoning it. So for another 6 to 12 months of payments, we are continuing to take that loan from non-performing to performing status. And once we've categorized it as a performing loan, we can either sell it back as a performing loan on the secondary market. The borrower might sell the home and pay off the loan, or refinance and pay off the loan. So those are some exit strategies there, exit options, I guess you could say. And then the lower route, which really doesn't account for as much of our portfolios, when the borrower decides, we don't want to work with you, we're never going to make another mortgage payment. In that case, we do go through the foreclosure process. Right now, we don't really take many homes back. It's not really we're very focused on mortgage notes specifically. We're not focused on holding properties. And most of the time, an investor will show up and buy the property at auction, in which case we are paid off the full balance of the loan. So something important to realize there, and in all these scenarios, if they sell or refinance, is that if we buy a $500,000 loan for $300,000, we're still owed that $500,000. So we're getting paid if that home was to go, if the borrower was to refinance the home, we would get paid the full balance, pending, obviously, there's ample equity coverage, which is important to our due diligence process, and something we take pretty seriously.
Speaking of due diligence, the steps to secure a mortgage note, it's very similar to buying a home. You put a preliminary bid on what's called a tape of assets, which literally is a glorified spreadsheet. We get millions of dollars a day of assets sent to us in an Excel spreadsheet, and typically have 3 to 7 days to bid on those assets. And then once we bid, they may accept it, they may counter. And then once it's under agreement, there's that due diligence period, which is like an escrow period during a real estate transaction, we, in this period, will send somebody to look by the property, and we'll talk about all the due diligence on another slide and our 3Ps. And then, that's typically a 2-week process. And then if there's issues with the loan that we find, we may fade the bid, or it might be, hey, it's what's called clean collateral, meaning there's no issues. And then we close. And then after the closing process, 7E is now the lender of that loan. So it's very similar, as I mentioned, to real estate. I think the main difference is this process is 2 to 3 week process, where real estate transactions are typically 30 to 45 days.
And then from there, really, we dive into once we're in that due diligence escrow period. And just to know, I am keeping your questions, pulling them to the side. So some of them we'll answer throughout, but if we don't, I have them there. I promise to get to them. So due diligence is where, they've accepted our bid. We're in that due diligence period. And this is where we kind of do our deep dive on the 3Ps, as we call them: the property, the person, and the predicament. The property really is the title clear? Is the structure standing? Is it there? What's the condition of the property? We get a valuation on the property. And is it a first position lien? We're having attorneys review, making sure if it's actually collectible, making sure that that borrower is actually the one on the mortgage. So looking into that, then the person, we're looking at their criminal history, financial history, running a skip trace on them, mortgage payment history. And then the predicament is really where I feel like we kind of have, that's kind of, I guess you could say, our secret sauce. It doesn't seem that secret. It seems kind of like an obvious thing to me at this point, but a lot of people overlook this. And really what we do there is we're looking at what caused the borrower to fall behind. And we take the prior servicing notes, which is the prior lender's servicer of record has to keep notes of communication with the borrower, anything sent to the lender, anything back and forth. And it really comes down to either a death, divorce, job loss, or some sort of like situational life event that caused them to stop paying. And we've also realized that sometimes the lender doesn't communicate back. As you can imagine, trying to get your bank on the phone and speak with an actual person who can help you is not easy. So in mass, dealing with people who are trying to, I want to make my payments. We've seen that multiple times, and the lender is just not getting back to them. So there's also that as well. So those are kind of the 3 things that we really deep dive into during that due diligence process before we decide whether to continue or fade or drop bids.
And one thing I'll mention is we do this on both performing and non-performing loans. And I mention this because I had somebody actually send me a performing loan across my desk this morning. And I looked through the collateral file, and the individual would be getting behind on her mortgage. And then every time she was behind, she was sending letters to the state attorney general and then threatening lawsuits that, hey, I'll settle this for, $5,000 or give me this much money. So it's important to understand that person, and whether it's performing or non-performing, we do this across every single type of loan. So I know there's questions about mortgage notes in the current economic climate and interest rates and what motivates banks to sell. Lauren hit upon this a little bit already, that if you've ever tried to call a bank and dispute a charge or just get them on the phone, you typically will spend at least an hour and get through 4 different departments. Now, that's for something that is, I think, minor. On the non-performing side, banks typically are not staffed to manage a large portfolio of non-performing loans. It also impacts their ability to lend to more qualified borrowers. If anybody ever wants to go down a rabbit hole, look up fractional lending. You can lose a week just understanding how banks actually lend. And also during high interest rate periods, they can get better rates on newly originated loans. So someone asked, why do banks sell loans at, a discount? And I think we have a slide later on this that we'll talk about. But, look at Silicon Valley Bank as an example with their bonds, and they couldn't sell them because their bonds were so low. Also, most people think that lenders want to sell because there's an issue with the loans. Not the case. It's portfolio rebalancing. For example, we took down a pool of loans at one point in time. There was a loan in Montana. We don't do Montana. So we just pierced that loan out and sold it after we bought that portfolio. And it could be liquidity, end of year. Companies might want more liquidity for next year. And like I mentioned, that buy box where it might not fit their tranche, like that Montana loan that we had.
like I mentioned, really these are kind of the 4 buckets along with lender communication. But that's not pertaining to the borrower. That cause people to fall behind, typically job loss, health, divorce, death, or some sort of life event. And it's pretty clear typically in the servicing notes what that was. Most people don't just wake up and all of a sudden we're looking at servicing notes where it was like, there's no communication. They just stopped paying. That's really, I'd say 1 in 10, maybe. So those are kind of the 4 things that cause people, in our experience, and we've done this over 600 times, 600 individual fix and flips that have caused people to fall behind on their mortgage obligations.
And Lauren, do you want to just briefly explain to people what servicing notes are?
Yeah, so every licensed servicers are required to service the loan. It's where your payments are going. They're the debt collectors. They keep records of communication from the borrower to them and communication from them to the borrower. So they're required in most states. So we have a servicer of record that works with us. We make the executive decisions, the financial decisions, and we evaluate the financial packages, but they do the direct communication with the borrowers. So we access those notes when we're looking at doing our due diligence from the prior lender or lenders, depending on how many times it's been sold.
And if you ever call your lender, you got to wait the 20 seconds because they give this whole spiel about we are a debt collector and and this call is recorded. So all of that recordings is actually part of the history. So if somebody later says something, there's a history there behind it. So
interest rates. Oh, go ahead, Chris.
Okay. So if somebody asked this question, I briefly touched upon it earlier. We bid based off of a targeted yield. So if we're looking at a 12% yield, we just gave some high level examples. Figures aren't exact, but if you're a $100,000 loan at 8%, to get to a 12%, it's basically about a 34% discount. And then a loan at 4%, we would be requiring that at such a steep discount, which is one reason why we typically don't see a lot of loans we're buying at 4% because the lenders just can't take that much of a haircut. One thing I do really want to focus on, though, on the interest rate environment is other asset classes in real estate typically are significantly impacted by interest rates because they're taking on debt, they're taking on leverage. We are the exact opposite, where we have no leverage within our fund, and the interest rate environment does not have a significant impact. There's some secondary impacts where as rates rise, we don't see as many refinances from that standpoint, but outside of that, there's not a major impact on the interest rate environment.
Are you guys willing to take a couple of questions right now?
Yeah.
All right. I'm going to, the very first question by Brooks was very general, and I think you'll probably get to it. So I'm going to hold it for a little bit here.
Yeah.
But I'll go down to Mario, who's asking, do you have a preferred percentage mix of performing to non-performing notes? How did you come to that split? Did you say that your current portfolio is 90-10?
Yeah, no, when I was talking about the 90-10, I was talking about borrowers that we go through the modification process with, which is about 90% versus the foreclosure process, which is about 10. Later on in this slide, we do have actually a portfolio overview that we'll share with you. And so right now we're at about 58% performing and 42% non-performing. And so that will fluctuate and back and forth, probably get to a place where about 60% non-performing, 40% performing. And again, it'll kind of ebb and flow. Will never be drastically weighted towards one or the other. It just depends on where in our flip cycle, I guess you could say, we are. So that's something we talk about a little bit later. Someone else asked about K1s and states we operate in. You'll see later we talk about our fund structure and the offering and how it works. It's not a K1, it's a 1099 dividend. So there may be some tax alpha there. So you're not having to worry about K1s, which I know a lot of people don't love. I don't, at least.
I despise them.
Yeah, part of how we built our offering was
My
really
CPA likes them.
Yeah. Part of how we built our offering was really surrounded around our awful experiences with other funds and things we liked and didn't like. So that being one of them, there are no K1s. It is a 1099 dividend.
All right.
About insurance to mitigate liability. if the house turns out to be a meth lab or something. So we can't go inside the property. You are right. We do get eyes on the exterior of the property. However, we also do put forced place insurance immediately upon boarding the loan and require the borrower to provide us with, which covers us essentially while we are getting proof of insurance from the borrower. Anything to add there, Chris?
No, and like that forced place insurance is something that we automatically put on every loan at the beginning, and then we have a third-party provider, insurance company, that actually will go and check and see if the borrower does have insurance, and if they do, then we just cancel it, but if they don't, they leave it on, and that is one of the major risks in note investing, and that's how we mitigate that. Is we just make sure there's always substantial coverage on every loan. Yes, I have had properties burned down and they weren't insured, so we were able to recover our funds from that.
Okay. I think the rest of them we're gonna cover probably. So
We cover a lot on the offering coming up in the portfolio.
yeah.
There was one question here from Glenn about sourcing. He's asking where are you sourcing your NPLs and your PLs? What are you selling but into the secondary market?
So typically on the secondary market, we sell our reperforming loans or performing loans. We have some performing loans we have within the portfolio. The non-performing loans, we like to work those out 90% of the time. If we get to a point where we don't feel like we can add more value to this loan, yes, we will sell it at that point in time. Where we're sourcing them, other hedge funds, actually merger and acquisition companies are very big into selling loans. They're called whole loan trading. They have a different department. And think about it this way, banks don't know, just like a car manufacturer, these large banks, they don't know where to go. So they have trading companies that will take the assets for them, put them out to people they know who are qualified, and then sell them. And the banks do that because they don't charge the banks. They charge us, the buyers, a very nominal fee. So as a bank, if they can have a third party who knows who can buy these and handle that entire process for them at no cost, it's a no-brainer for them.
Do you ever sell partials?
Not anymore. Back in the day, I had 75 partials going on at one time. But because we're a fund at this point in time, it's, the stuff we sell is just whole loans. But I do know people who do sell partials. If somebody ever wants to reach out, I can connect you with people who have a good reputation in the space, because it's very important to understand who you're dealing with within the space.
Was your decision to switch over to selling the whole loan, was that due to the economic reasons or the logistics of tracking it, or just the relationships with the people you're selling it to? Why'd you make that choice?
Yeah, I laughed when you mentioned partials, because I actually was helping at the time when I started working with Chris. I was helping manage all those partials. 75 is a lot. There's a lot of little things that go into it: paperwork, processing, amortizing, all the things. So now selling into the fund, people aren't tied to one loan. You're tied to the entire portfolio. So it just made more sense once we switched to the fund method. And Chris had been doing some funds at the same time, kind of alongside. So saw the difference in, I guess, both management of and time, but also from an investor perspective. I mean, you're getting about the same thing as you would on a partial, with less risk because you're invested in everything.
Right. Makes
the
sense.
other thing I'll add is I would always maintain control of the partial, because if I gave it to the investor, typically they might not have the experience. So if a borrower misses a payment, what's the first thing to do? Call me. And each partial is really like managing its own separate business. You'd have to keep separate books on it, separate P&L, separate bank statement on things, make sure the payments are coming in. So after I started the first fund, it's like, wait a second, with the fund, it's all the assets, it's one entity, treated like one entity, and investor's an investor. Whereas on the partials, it's like individual, almost like LLCs. They weren't separate LLCs, but it's almost treated like one. Want us to keep going?
Yeah, why don't you keep
Okay.
going? We've got more questions, but as Lauren said, I think you'll get to the answers.
We're going to get to a lot of them, and I want to make sure that
Okay.
we get to
Just so you know, we've got 20 minutes left.
Yeah,
Okay,
that's
so-
I just chatted Chris, like let's do this.
Yep. So one of the things we really focus on is having equity in the property. And we like to buy loans that are older. So if a $250,000 property has a $100,000 balance, you can see the equity. Then at a discount, you can even see we're at a 25% investment to value. We get to that point because loans that are 10 years old, people pay it down, properties appreciate, it keeps that spread. Want to talk about this one, Lauren?
Yeah, it's non-correlated to Wall Street. I think, and I work with a lot of investors, RIAs, financial advisors that we have partnerships with. And probably one of the biggest things I'm hearing right now is, hey, interest rates are down. Probably you're going to continue to drop a little bit. So for example, treasuries, the last 3 months have been under 5%. CDs are getting called. CDs don't look as attractive anymore. So they're looking at our fund as you don't see our screen anymore? Does anyone else not see our screen? You see it. Okay. Glenn sees it. So essentially just looking to other alternative options for passive income. That's what we do. It's risk adjusted. We focus on consistent cash flow, and we have a flexible entry minimum of $5,000 with bonus equity starting at $25,000. And we'll talk about that in a second. So this is really an investment for people who are looking for hands-off investing. We manage every aspect of the investment. So if you're someone who likes a lot of control, this might not be for you. This is truly for people who want that passive income, no tenants, no termites, no toilets, just consistent returns. We've done this over 600 times. We have a track record. You can reach out to us. We also have a third-party track record verification report, over 700 investors. And our IR team is internal. We have an in-house team. So that's really important to us. Our investor relations team and our asset management team, both being in-house, allow us to really move through the asset management process quickly. And, if you're an investor, you can call in, you're going to speak with Katie, you're going to speak with Tony, you might even speak with me, depending on the day. So risk-adjusted returns, I just mentioned, it's not correlated to the stock market. I always use the baseball analogy, which is funny because I'm not a huge baseball watcher, but it's an easy analogy for most people to understand. We like to hit consistent singles, doubles, maybe a triple. Are really focused on capital preservation, risk mitigation, not striking out, and providing our investors with that consistent return. Again, we do have a third-party track record verification report that I can send if anyone's interested. It was done for a family office that we work with. And so it's something that they required. It's by a third party. They verified our past returns, how we calculated them, and everything. So again,
as Lauren mentioned, we've done over 600 deals, over 100 million. We've invested in over 40 states, and the 5 prior full cycle offerings. And again, if people want to see that track record verification report, we are happy to share that.
Yeah. Someone asked if we've ever lost any money. We haven't lost any money. We've overperformed on our past funds and never lost investor capital principal. Just to cover this really quick. So this is our portfolio as it stands of July. At max, this portfolio has had over 150 loans. We're in our, I guess you could say, flip cycle where we're selling off to reinvest that money. You can see our average discount there is 36%. You can see the states we're in. You can see our investment to value, which again is super important, knowing where we are from an equity standpoint in that $1 million property, what equity is there, and then the number of loans based on performing or non-performing status. And
this next few slides will answer a lot of the questions that are coming up. So
this is a Reg A offering. Important to know, Reg D, you sign a piece of paper, tell the SEC, I'm raising money, this is what it is. Reg A, you actually have to be qualified by the SEC because you are allowed to market to and raise money from both accredited and non-accredited investors. We have to submit audited financials once a year and unaudited financials once a year. So again, Regulation A, open to accredited and non-accredited investors. It is a 4-year term. Really, that's a 4-year lockup, meaning Your money can stay in the fund after. You can request redemption at the end of 4 years. You can partially request redemption. So it's 4 years from your date of investment. Minimum investment is $5,000, though we do offer bonus shares or equity at $25,000, which you will accrue 8% on, but also be able to redeem for the cash value at the end of the term. This is really important. Go ahead, Chris. You're better at this.
Yeah. So many people are familiar with the capital stack of, common equity, preferred, mezzanine, and senior debt. As we mentioned previously, we don't have any debt. So investors are preferred equity, they're shareholders, and essentially they're at the bottom of the capital stack. Lauren and I have the common equity company, and I did see a question about no fees. We'll talk about that in a minute, but I'll just briefly mention Lauren and I don't win until investors win, and we'll talk on the next slide. But we really wanted to share the importance of no debt within this offering, and investors are at the bottom of the capital stack.
Glenn, you asked a good question about tenant friendly. They may be tenant friendly, but we're actually not landlords. So it really matters more if they're foreclosure friendly. You can see we don't really love New York, New Jersey. Those are states we try to stay away from. So big difference there between tenant friendly and bank lender friendly.
Yeah, the one thing I'll mention too is California is easier to foreclose than in Florida. Much easier, believe it or not.
Yeah. I think that yeah. So some of our offering highlights, I'm looking at the questions, sorry, as well. It's open to self-directed IRA accounts or cash accounts. We pay our distributions monthly, and that happens within 2 months of investing. So for example, investors who invest in November can expect their first distribution January 1st. So their interest starts accruing December 1, first payment January 1. We have up to 4 times collateral coverage. Again, equity is super important when it comes to if we have to foreclose, if we're getting paid off, if we're selling back the loan on the secondary market. It's not a blind pool. So we're not pitching you on, hey, we have this development project. This is what it'll look like if we can raise all the money. We are monthly raising capital and deploying that capital into assets. There are no fees. And someone just asked, and I just saw this. So you would not get hit with UBTI if you invested with a qualified account because we are a C Corp and we don't have leverage, both of those reasons. No fees. All fees are paid by the management. We make money when our investors make money. It was really important to us when we set out to do this that we had a vested interest in, we both have invested in funds where people collect management fees, and it doesn't matter if the fund does well and they make money regardless of how the fund does. So for us, we make money on the upside after investors are paid. And then, like I mentioned earlier, taxes is a 1099 dividend. And again, I'm not a CPA, check with your CPA, but there should be some tax alpha as dividend income is not considered ordinary income when it comes to tax brackets. Yes. I talked about this bonus shares earlier and the bonus share equity, and this is kind of confusing. So if anyone, again, has questions, you can reach out to me when I can break it down a little bit more, provide you with an investment overview for a specific amount. At 25,000, you can see we start offering 4% bonus shares. Again, that goes up at 50, 100, and 250. Now that is sliding, so it's not 25,000 and 49,999 get the same amount. It's 4% of your investment amount. So at 25,000, you're getting 100 bonus shares, which essentially bumps your overall IRR to 9.19 because you're both accruing 8% on that extra 100 bonus shares, which is $1,000. But at the end of the 4 years, you can request redemption of both your 25,000 and the extra 1,000 bonus shares that you are awarded.
I'll talk briefly about 2 case studies we have. The first one is a property we had up in Maine where the borrowers owed a little bit over 200,000 and they were about 10 years behind. So most people think, oh, I'm a month or 2 months behind. Most of our loans are 2 to 3 years behind. This one was really behind. So we were able to purchase it at a very steep discount of $80,000 because there's also some slight title issues on this property. It was valued at $275,000, and when we purchased it, like I mentioned, they were significantly behind. And after the title issues got resolved, we bought this property. Now, first things we typically do, as Lauren mentioned, is we file a demand letter, which is starting a foreclosure process. And during this process, the court in Maine says, hey, you have to go through required mediation. And we were working with our servicer at the time, and the state of Maine was giving $50,000 to lenders through the borrowers to reinstate loans or bring people current. So we worked with the state and the borrower to get $50,000 to pay down the past due. We modified the loan and restructured it so the borrower could pay, and basically, ended up, and we actually did sell this loan back on the market. So this was a situation where, I know someone mentioned in the questions, like, does the servicer always talk to the borrower? This is one of the situations where we were in mediation on the phone trying to work out the details, but it's very, very rare that we ever speak to a borrower. The only other occasion is if, it's typically a mediation or we're just settling numbers. It's not to reach out and say, hey, where's your payment? The next case study is more of what I like to say is our bread and butter. This one was over in Denver, where owed a little bit over 150, about $25,000 past due. We purchased this note for 100,000. It was a $400,000 property. And this is what Lauren talked about earlier. The prior lender could not get out of their own way. They took 9 months to send a package to them to get them to try and restructure the loan. The borrower submitted the package, but it went round and round where they canceled it because it took long. They took too long, meaning the lender took too long to process the paperwork. The borrower was trying to make payments and the bank wouldn't let them. So we bought the loan, worked out a new plan, which was almost identical to their old plan with the borrower, got them to sign an agreement to structure the payments that they were paying extra. We modified the loan after they continued to pay. Then we turned around and sold that loan back on the secondary market. And just as an example, when people ask how we make money, this one we bought roughly for, call it 65, 70 cents on the dollar. We collected, monies, call it $10,000+, and then turned around and sold it for, 85 to 90 cents on the dollar. So that's how we gain. And if this would have gone to foreclosure, because someone asked if we get paid in foreclosure, an investor, we would bid $150,000. We would bid this 158 at auction. If it's worth 400, an investor is going to come in and bid well above us, but we just get our payoff.
So I'm sharing this here. I know we threw a lot of information at you. If you want to book a call with me, I can kind of answer more questions. I'll also drop the link in there because I know some people don't love QR codes, but there's a link to my calendar. I'll drop it in the chat, and a link to my email as well. It's just Lauren at 70 Investments. But I'm going to go through some of the other questions we had really quick. So what is the overall expected return after 4 years? So it is an income fund. You're getting that 8% annually paid monthly on whatever you're investing. Now you can see the bonus shares really just kick that total IRR up because you're going to get 8% on your investment amount plus the bonus share amount. But at the end of term, you're also able to redeem. So at $100,000, you're getting an extra $6,000 a year that you're going to accrue, or $6,000, not a year, $6,000 one time, where you're going to accrue 8% on. And then at the end of the term, you're able to redeem that $106,000. So I'd say it's 8% plus, and it just depends on at what tier you invest in. But the 8% is the cash you're paid on, or what you're going to receive annually based on your investment amount. The kicker comes at the end.
And one thing I'll mention is after the 4 years, you can stay in the fund. You can take a portion of it out, or, just let it ride. There's no, if you don't renew that, it kicks in for another 4 years. It's completely after 4-year mark. Any day you can ask for redemption.
And someone mentioned, what's your track record on monthly payments? It's an 8% pref. We have not missed in this fund or prior 5 funds, a distribution or payment to investors. In fact, most of the time we're a day or two early, which has caused people to be like, wait, it's the 29th. I'm like, yeah, we actually don't owe you till the 1st. So typically we're on time, ahead of time. And I think something that speaks volumes that I didn't really start talking about until recently when I met with an advisor and he was like, you should share that. Is that we have, like I said, we have 700 investors plus, but and that average investment is just under 50K. So you'd think a lot of people do 5. Most people that do 5 typically do 5 to 10 as like a, hey, I'm going to test it for a few months, and then come back with a bigger amount. But we have a 40% reinvestment rate. So investors who invest with us really, again, do like how we work, how we operate. They've seen the returns. And I think that speaks a little bit to like how we operate both internally and as a fund. Someone did ask this, I think Chris answered it. If we foreclose, we still make money for the investor. A lot of people actually get into this thinking foreclosure is the best route. It's not. So let me see.
Because of time. It's a lengthy process.
I don't know. I didn't see any other questions that we haven't answered.
I think somebody asked a question about, 700 investors, how do we manage them all? And, our software through Appfolio that we use. And again, we have an in-house accountant and we have Tony and Katie as well. Everything is in-house with the company. So it's, much easier when you have everything insourced and not have a part-time bookkeeper with a part-time third-party investor relations somewhere else.
Yeah, I mean, we have a specific inbox that's monitored by Tony every day for our investors. I actually look at it as well. You'll get an answer probably same day, if not within same hour. We're pretty on top of it. Someone said, so worst case, you get 8%, and at the end of 4 years would be 5K return if you go with the minimum. Correct. That is correct. So if you go with the minimum 5K, you're getting that 8% on your 5K annually, paid monthly, and at the end of the term, you can request redemption for your 5K back. So. Any other questions? Again, if you want to book a call with me, I did drop my link and my email as well. If you just have some questions or you want to follow up and get that track record verification report, feel free to reach out. We also, if you're like, I don't know, that was a lot of information. I want to see more. You're trying to wrap your head around what we do more. We do send out weekly case studies every Saturday. So if you go to our website, which is 7E, just the number 7einvestments.com. I dropped it in the chat. If you put that 7einvestments.com, you go to 7einvestments.com. Oh, it's also on the slide. You'll be able to join our newsletter. We don't spam you. We invite you to any webinars we host internally. We have one next week on our due diligence process. But we do send out those weekly case studies. We talk about the economic environment, what we're seeing. Again, we don't spam you. We keep it to one email a week, unless we have a webinar. But I know a lot of people don't necessarily want to book a call right away. They might want to, sit back and kind of creep in the background, and I welcome that.
Hey, Lauren and Chris, we've had a tremendous number of questions during this meeting, and I think we've gotten to most of them, except for the ones that just came in here.
Yeah.
I was going to suggest, if you guys don't mind, maybe just staying around an extra 5 minutes, and for those people that still have questions. But for everybody else that's out there, can you take yourselves off of mute and thank Chris and Lauren for coming in and speaking to us today?
Thank you.
Thank you so much.
Thank you.
Very
Thank you.
interesting.
Thank you.
Thank you.
Thank you
Yeah.
both.
Thank you so much.
I think someone asked about I want to share something really quick with you guys. I have to make
Okay.
sure I don't have
While you're sharing that, Lauren? No, go
the
ahead.
bonus share thing. Yeah, you answer questions while I get this ready to share.
Yeah, so someone asked about the team and overlap. Yes, we have overlap. We also have key person insurance on Lauren and myself that the company owns. So if, verbally, something were to happen, we are covered for insurance as well as replacements. But yes, we have overlap within every individual within the company, and systems in place through third-party reports that we've done as well that, have very good SOPs in place if this happens, and contingency plans.
Was key person insurance something else you had to put in place for the family offices?
No, but
It's good to have.
it's good to have. And so when we started working with broker dealers and RIAs, because we do sell into that market as well and their clients,
Yeah.
we had to undergo what's called a third party it's always a third party. It's like a sponsor report, and they deep dive into your offer and you as a company. And that was something that I'm glad we had in place, because they do ask about it when they're kind of interviewing you and going through that process. It's important to bigger institutions. We're on the Schwab platform for some advisors as well. So it's important to them to see that we have that in case
Oh,
of
good for you for being on Schwab.
Yeah.
All right. I wanted to let everybody know that it is the top of the hour. If you need to drop, now's a good time to do so. But if you have questions and you want to stick around for another 5 or so minutes, feel free to do that as well. We'll see you all here next week, Friday at noon, the Alternative Investing Club.
Thanks, guys.
Thank you.
Yeah. So I don't know, for those sticking around, I wanted to share this because I think this will help clarify a lot. Let me pull this up. So if we look at that $5,000 investment, and if you email me and you want different investment breakdowns sent to you, I can definitely send these over. But essentially you'll see, okay, so you're getting initial investment is 5,000, you're getting 500 shares, no bonus shares at this tier. You're getting about $33 a month, and every year you're going to get that 8%, which is 400, which breaks down to that $33 a month. In year 4, that's when you can say, okay, I want my money back. You would get that 400 throughout that year, and then you'd be able to request redemption of your 500, which you do not pay taxes on. Think of it like investing in stock, Apple stock. You're getting that dividend.
Lauren, Stephen and I or Chris and I just put your email address in for somebody who was asking for it, just so you know.
There you go. I know. I think I might have sent earlier my email and someone to one person. So I'm just going to drop a link to my calendar as well in there for everyone.
There you go.
And then 25, let's look at the bonus share tier, the $25,000. So you can see you're getting 100 bonus shares. That's worth $1,000. So you're going to accrue 8% on $26,000, which is about 8.32 a year. So you'll get 2,080 a year, which breaks down to $173 on average a month. By day, you can see February is a little bit less days in the month. We always get that question from some newer investors, so I like to mention that. And at the end of year 4, you can see your return. There's that kicker, because not only are you getting the 2,080, but you're able to redeem 26,000 at the end of that 4-year term, which bumps up your IRR. And again, so on at 50,000, you can see it goes up again. No, it didn't. Oh, there we go. Delayed a second. It goes up again. It goes up again at 100 and 250. Again, sliding. So if you invested 50 or 60,000, you wouldn't just get, 250 bonus shares. You get 5% of that. So, I hope this helps. I feel like sometimes it's a good visual. And again, if anyone has any questions, feel free to reach out, book a time on my calendar. How many full cycles? How many full cycles of the fix and flip, or how many funds? I don't really know what that question means.
Yeah, there was 5 full cycle funds that we went through. This regulation A was started in 2022. I've been buying and selling notes since 2016, and the first fund I think was 2018, I believe.
Yeah, so those 5 funds have gone full cycle. This fund is different in that it's a evergreen fund. So there's that 4-year lockup, but everyone's lockup will be different depending on when they're investing.
M. Hickle has a good question here. He's asking, do the accounts have to be qualified? Must qualified accounts be self-directed? I'm sorry.
Yeah.
Or can I invest directly?
Yeah. So with they do have to be self-directed accounts. Typically with a third-party custodian, not Schwab or Fidelity. We're not on the Fidelity platform. With Schwab, we are on their managed accounts platform. So we are currently looking to see if we can also accept investments from Schwab on their, I guess you could say, public platforms. We have been told we are able to by Schwab. However, once you start working with Schwab, Fidelity, and all these companies, you realize they're actually so big and there are so many departments that we're actually waiting on a transfer from. We have a current investor who was with Quest. Quest was just acquired. They're actually transferring it to Schwab. So we'll be able to know very shortly if that is true, because Schwab said, yes, totally, you're already on here. We see everything. But because Schwab's managed accounts and Schwab's public accounts are managed by different departments. We want to make sure that goes smooth. That's why I haven't made that announcement yet to the public. But once we know when we can, we will definitely be making that announcement. So,
and then the other part of that question is, can they invest directly? I assume that's a yes.
oh yeah, you can invest directly. It can be a cash account, saving, checking, trust. We have some people that invest with entities. So yeah.
Okay. Anybody else who has questions, feel free to take yourself off mute and just go ahead and ask them. I think we're going to be winding down here in a moment.
I have a question. My name is Kailas. What happens if we have a 2008 kind of like real estate crash? How well protected are you?
Yeah, we actually, and I'll let Chris really go nerd out on this a little bit more, but this specific asset class does really well in an economic recession. I'll talk about COVID, for example, which was not 2008, but we saw a lot of people refinancing. We saw a lot of payoffs. Interest rates were super low, different from 2008, where you had people walking away from their properties and being like, I'm going to go rent something next door. There's no inventory. Rental rates are through the roof everywhere. So most people have an interest in staying in the home they're at for their mortgage of $3,000 for, say, their 5-bedroom, 2-bath home versus trying to move and not being able to afford a 2-bedroom, 1-bath for that same price. And I'll let Chris talk a little bit more about this.
Yeah, so in 2008, there's somewhat of a running joke within the space of, if you're involved in note investing in 2008 and still around, you want to scratch your head because people made so much money during that time in defaulted loans because there's so many of them and they could buy them at a discount at prices. We're never going to see that again, and we don't anticipate that. But in regards to home prices significantly dropping, that's where when we structured our portfolio, looked at that low investment to value. So in one of those slides, if a $250,000 house where the note was only $100,000, if that house dropped by 50% down to $125,000, they still have equity. It's a $100,000 note, and we only paid, call it $70,000 for it. So that's one of the things we really focus on looking at is, buying properties with that significant equity. We're not buying loans that originated 6 months or a year ago, or like properties that were in the Smokies, as an example, is an area that I think is getting hit pretty hard, where prices went up significantly, and now you're seeing those come down. So we're very conscientious on the areas we invest in, and also that low loan to value and investment to value on those assets. So if there is softening, which I believe we are going to have, within the real estate space on pricing, that it should not have any major impacts on our portfolio.
Oh, thank you very much.
Yeah.
Okay, do we have any other questions? If not, we'll let you two go. Thank you, Chris and Lauren, for being here. It was really a pleasure to see this.
Yeah,
Thank you,
thanks
Dana.
everyone for joining us. If you have any questions, feel free to email me or reach out. I cannot share the Excel. It's an internal doc. But I can send you an overview. If you have an amount, reach out to me. And if you are interested in joining our webinar next week to kind of learn more about what the due diligence process looks like, head over to our website, join our newsletter, and you'll get sent an invite. Thanks, Daniel, for having us. Thanks, you
Thank
guys.
you.
Happy Friday.
Thank you
Happy
all.
Friday.
Bye.